Sindhu Samir of Emkay Global Financial Services. Hi Sindhu, good afternoon and thanks a lot for joining us today on Bloomberg Quint. What have you made up of the rise in the global crude oil prices that we've seen? Of course, some bit of reprieve now coming in, cool off in the prices overnight after the Saudi minister stated that the production will be restored by the end of this month. That's had an impact on Indian markets, and if prices were to scale higher, let's say from current level, it may not be a great news for India considering we import 80% of the requirement. In view of all that, in light of all that, Sindhu, how would you approach the oil sector or the oil sensitives?
So first of all, it's not a given that oil will be permanently high. And look at the trajectory of oil since 2014. I distinctly remember that it was $119, and from there it came all the way down to $14 or to $40 or $50 per barrel. Now, the case for oil structurally cannot be made on a very bullish basis. So oil, like many other things, I will not use a dramatic word, getting disrupted, but case for making a super oil or oil in excess of $80 or $90 is very tough. Of course, there has been a temporary disruption in supplies, but I don't know why the discussion is never centered around the Saudi reserves. So yes, there has been Saudi being 10% supplier to the world, out of which 50% capacity is off. But we should also remember that Saudi is also having one of the largest reserves of oil in the world. Also, the marginal capacity which is sitting on the fences in such a kind of a crisis becomes economically viable. So if given my personal view, I don't think so this situation will last for long. And since it's not going to last for long, taking a call on stocks based on this kind of a temporary spike will not be a very prudent thing.
Fair enough then. In that case, Sindhu, let's talk about Indian markets in general, specifically the large caps. Let's just focus on the top 15 caps when it comes to market capitalization. If your clients are coming and approaching you on some of these names, are you actually asking them to stay in them, considering we are seeing so much volatility and there's a likelihood that some of these names will at least hold on, if not correct substantially? Or are you saying that, these are very, very richly priced and you'd rather stay away and move out and possibly find other opportunities in the markets?
Okay, so let's demystify the question which you have asked me. First of all, staying away from equities is essentially a call between cash and equities. So if anybody is seeking advice from people like me, I assume that they have already bifurcated their portfolios between cash and equities. I have nothing to do with cash. Regarding equities, of course, there has been a challenge. Indian GDP has fallen to 5%, but let me take them back. See, the biggest teacher in the capital markets, apart from the EPS and other measures, is the history of capital markets. In 2012 and 13, GDP had come down to as low as 4.7%. Now, if anybody would have been tempted to spread it across to the subsequent years, that would have been a cardinal error. So if the GDP is down to 5% and a lot of voices are getting pessimistic, I don't think so that is a prudent way. It is almost given that India is not going to settle down at a 5% number. From Q3, you will have a base effect. I am not selling a case for macro fundamentals out here, but the point is that at 5% GDP, if anybody is choosing to go, you can say, down or negative on Indian equities, that's not what has been taught to us by history in the past 15 years. I am still in the camp that the nominal GDP growth rate of India will rebound from the current quarter's 8%. And if that is going to rebound, and if equities in the long arc of things is likely to trail the nominal GDP growth rate of India, then to be extremely pessimistic at these levels. Second question is that what do we do about the large caps? The large caps, or the Nifty, which represents large caps, is roughly around 16 or 17 times forward. Now, it is not a cryingly cheap market, but then it was 19 times forward. At a 5% GDP print, 17 times forward I don't think so. It is a very expensive market. Now it looks very expensive if somebody is just focused upon the next year. If anybody who wants to get into equities can just enhance or explode his portfolio to his horizon to 2 years or 3 years, it makes a compelling case. Now the word compelling, the superlative compelling might look a bit aggressive, but look back, in majority of 3 years, whenever anybody has chosen to invest in equities in India, he has not been or she has not been disappointed in a major way.
Okay. Well, it remains to be seen whether the growth rates from here are bottomed out or not. Let's see if the economy revives. But we were talking about large caps and, something like HDFC, that's a heavy weight, remember, on the index with a weightage of about 10%. It's corrected almost 8% so far this month. And let's not forget, it's FI owned, and we've been highlighting how the FI selling in our market remains unabated. So my next question, Sindhu, to you is, what's the reason why FIs have been continuously selling into our markets, and these slowdown fears were there even during the budget time, and FPI issue which came post the budget, that surcharge has been rolled back. So what's stopping the FIs to put in their money into the markets right now? Because now is the time, there is some bit of fear because these bluest of the blue chip like HDFC owned by FIs, that's seen selling so far this month.
Okay. Now let's take a counterpoint. If FIs have been continuous sellers, I can also put a counter argument that the domestics have been reasonably buyers in the whole space of time. So if FIs are sellers, the domestics are buyers. In a single month, India from the domestic money attracts somewhere around 8,000 to 7,000 crores of net inflows in equities. Now this is a mountain of inflows which comes from the domestic space. Just 5 years back, this figure used to be a fraction of the figure. So either we can look at the continuous selling of FIs, YTD, or we can also look at the continuous buying from the domestic space. Now coming to the point that why bluest of blue chips, I will not take any name, are coming down. Then the point is that now, if anybody chooses to look and invest in the stock of a leading bank, he should be very cognizant of the fact that he is not making a fixed deposit in that investment, in that bank. Now, equities by their nature are inherently volatile. So, volatility can be taken as an opportunity to buy a great company at right prices, or one can choose to scare himself about the same thing. All said and done, India, the guidance given to us by the central government is that India at one point of time will be a 5 trillion economy. Now, if I choose to play on that guidance, how do I best play it? Now, banks and private sector banks are the best proxies for that. Either I can just work myself up and say, okay, that these things are getting volatile, or I can peacefully acquire these banks, sit tight, and see what will happen in coming 4 or 5 years. Look back at the trajectory of the same banks, how much wealth they have created, and in what a peaceful and secular manner.